Hello and welcome to the latest edition of the Essential Six, your regular 6-minute update on the UK economy. And as ever, I'm joined by RSM Chief Economist Joe Brusuelas. Hello, Joe. How are you today?
Good afternoon, Simon. I am doing well here in sunny Austin, Texas, where it's nice and tropical today for a day when global central banks like the BOE are on fire.
Well, let's talk about that. Today is the day the Bank of England MPC unanimously agreed to hold rates at 0.1%. There was some talk a few months ago that they might be edging towards negative interest rates. Were you surprised by that?
No, I think that the fact that they chose to maintain the status quo, it's not 0.1% on the policy rate, a pace of asset purchases, that's purchases of treasuries at 875 billion, that's 1.2 trillion in US dollars. But they did provide some interesting forward guidance for us. What they basically attempted to do was to craft a scenario whereby, yes, we think things are getting better. We'll talk about the forward-looking outlook in a second. But in case things are a bit more difficult than we think, we will resort to negative interest rates, that's nominal negative interest rate policy, if we have to, and banks should begin to prepare for that. We estimate that it would take 6 months to basically move from current policy to that policy. Moreover, and this is important, it implied that they're getting to work on a technical basis to craft what's called tiered interest rates, which is a complement to nominal negative interest rates. Essentially, different interest rates on different rate on the policy versus what you might pay on loans for an auto or a mortgage. Big stuff today from the Bank of England.
Talk about the forecast. I mean, so hold on, that interest rate tiering process, why has that not happened before?
Okay, so we're in never, never land when it comes to central bank policy as it responds to 2 decades of crises. We went to the zero boundary, zero interest rates, asset purchases, nominal negative interest rates by the European Central Bank, Japanese Central Bank, and the Swiss National Bank. The sort of frontier of an orthodox and experimental monetary policy now resides in tiered rates. It's a necessary technical complement to nominal negative rates, which is essentially a tax on all cash holdings. It's designed to get an economy moving at a much quicker pace. But there's real reticence at the Bank of England, while the four external members are willing at least to consider experimental with negative rates. The 9 appointed members are not. My sense is the UK economy is a lot like the American economy, and given the predominance of financial services and banks, especially the City of London, you don't want to go nuclear unless you absolutely have to. And right now, it's not necessary to go nuclear.
Well, I was going to say, given that no one else is doing that, why would the UK monetary policy change?
They won't and they shouldn't. But it's good to prepare in case something goes wrong. But right now, I think we've got a much more optimistic scenario about what the second half of this year and certainly what 2022 is going to look like, not only out of the Bank of England, but our own RSM UK forecast.
Well, I mean, we've got a couple of minutes left. So you called it pretty much spot on. I think you said at our recent Business Leaders Summit that growth for 2021 in the UK will be around 4.5%. The bank have suggested it's going to be nearer 5%. So, fantastic. But next year, 2022 is when it's really going to happen, isn't it?
And this is when all RSM UK personnel and all of our clients and everybody in the UK should sit back and smile. The underlying resiliency of the British economy will come to the forefront. You're going to see 7 to 8% growth rates in 2022. As a resilient economy is led by the UK household. What's really interesting here is if you take a look at excess savings compared to the pre-pandemic level among British households, savings is at 16.7% compared to around the 7% 20-year average. As we get mass distributions to the public, as we reopen the economy, there's enormous pent-up demand for goods and services that will begin to flow. And with savings at that rate, that just about guarantees 2 years of very robust growth in the UK economy, my sense is it's going to spill over into 2023 as British firms, after the long period of uncertainty caused by Brexit, begin to reinvest in themselves. And let me give you a preview of coming attractions. We're going to be putting out something in the UK over the next couple of weeks, which makes the case that middle market firms need to invest in themselves and their businesses, while interest rates on an inflation adjusted basis are negative. This is a once in a lifetime, once in a career arc opportunity where you can borrow $1 million, pay back less than what you borrowed, and the return on investment will far outstrip what you're going to, the cost of making that investment. We have to move now. Now is the time to go big, go bold. It's going to be an exciting couple of years for the British economy.
It does sound it. It's all reliant on consumer confidence. So let's ensure that the mechanisms are there to make sure that confidence comes through. Joe, we're out of time. It's flown by. Thanks very much. Thank you all for watching, and we'll be back shortly with the next episode. Thank you.
Thank you.